Hello everyone and welcome to episode number 3 of the Candlestick Course for Beginners. My name is Mr. Crypto Tracker and I'm going to teach you how to trade with candlesticks. Before we start this episode, please make sure to subscribe to the channel if you didn't do it so far, and also turn the notification bell on to get notified when a new video comes. Early recognition of potential trend reversals is one of the most important skills a trader or investor can cultivate. As you study candle charts and learn to recognize single candle lines and patterns, you will appreciate how candles offer an early heads up on possible trend reversal. In fact, most signals given by candle formations are reversal signals. Candle charts often display reversal signals in a few sessions rather than over the longer time periods often needed for bar chart reversal signals. Using candle charts, you will identify market turns quickly, which should help you to enter and exit the market with speed and accuracy. In this episode, I will present the basics of trend reversals and how candle plays such an important role. Also, I will talk about support and resistance levels and all the important breakouts and price closes above and below those levels. So in this episode, you will learn how candles play a powerful role in recognizing early reversal signals, how candle lines and patterns confirm support and resistance. Also, you will learn about the importance of confirmation and why the closing price plays a key role in breaks above resistance and below support. The ability to recognize a potential trend reversal is one of the most important skills you can cultivate. Your ability to read candle lines and patterns will increase data skills many times over. In this section, I will dive into specific candle lines and patterns and the signals they give in the context of uptrend, downtrend, and trend shifts or trend reversals. Let's start by examining the anatomy of a trend reversal. Although market cycles of alternating uptrends and downtrends containing peaks and valleys are inevitable, you should remember that trends don't always end abruptly. In fact, trends usually occur slowly in stages as the underlying psychology shifts. Remember the old market saying, the trend is your friend. Successful trading entails staying on the right side of the trend. Trend change or reversal signals are the market's way of warning. It means market psychology is in transformation and you need to adjust your trading style to reflect that environment change. For example, if you see a reversal signal, you might consider opening a new position only if that signal is in the direction of the major trend. Let's say your stock has been climbing in a strong uptrend, like what you can see here in this chart. Then it either consolidates sideways for a few sessions or moves down or retrace to prior support. At this time, you get a bullish candle signal. Since the major trend has been up, one can use the bullish candle signal to initiate a long position. A bullish candle signal in a bear trend should be used either to cover shorts or as an alert that the market may rally and to use that rally to sell since the major trend is down. Look at these charts here. You can better understand what I mean. The context is downtrend and every uptrend here is a good opportunity to exit the market. Trend reversals or shifts are a modification in market psychology. In a strong uptrend, like what you can see here, the bulls are in control. By the bulls, we mean buyers, and with the bears, we mean sellers in this course. When a retracement or sideways conditions occur, like what you can see here, this move is a retracement, and here you can see consolidation. The stock rests for a time, then resumes its climbing upward. In this chart, you can see the market tops out at this point and here. Of course, we don't know it is a top until a few sessions later when the stock descends. Again, those with long positions may have taken some or all of their profits either here or here at this point. This time, however, the retracement turned into a trend reversal, barely stopping along the way. You can see here, it was in an uptrend until this point. Then you can see we are in a very clear downtrend and you cannot see any major moves to the upside. So these 3 points are reversals. And as we don't know the extent of the move after the reversal starts, the candles will often be the first clue of a change in trend. Besides scanning for possible trend changes, another critical component is asking where are support and resistance. Support and resistance on a chart can take multiple forms. It may be a prior high or a low, depicted in a price level or pattern, as you can see here. It may appear as an indicator shows it, such as a trend line. You can see a trend line here. A moving average here. This moving average can use as a support or resistance, or something as basic as the most recent high or lows. For example, here you can see this is the most recent low, recent high. It can be a resistance next time if the price can reach this level, and here it can be like support if the price reach this level. We know that a market often tops out at or near the same price range at which it pulled back at the previous time. It may also fall to a prior low price, then bounce off of that support level. You can see what I just explained here. Here, this area was the support, previous support, and you can see when the price approached this support level, it bounced very strongly to the upper resistance, which was here. If a candle signal confirms a support line, it would increase the potential bullish implication of that candle signal more than if that candle signal did not confirm support. Conversely, if a bearish candle signal emerges at a resistance zone, the chances of a turnaround have increased. So the rule is that the more technical signals, whether they are candle or indicators or a combination of both, the more likely is a reversal. At the start of this episode, I talked about the importance of the market's daily close. Let's take this a step further here. Like most technical analysts, the Japanese place great emphasis on a security's close price, especially if that price closes above resistance or below support. Think of it this way. If a stock, for instance, closes above or prior high, if stocks, like what you can see here, if a stocks close above the prior high, It means market participants are willing to pay more for it right then, and they're willing to hold it overnight. That means they are committed. And commitment is an extremely important factor in the movement of the financial markets. An intraday break of support or resistance does not have the same significance as a breaking of support or resistance on a close. Let's say you are studying a daily chart of a stock, like what you can see here. Imagine it had moved sideways. It had moved sideways like this in a basing mode between $40 and $50. Here, $50 is the top range and the 40 is the low range. It continues for weeks here. Suddenly, the bulls take control of the market and the stock closed above the $50, above this area, which was a resistance for us. Do you see how important that closing price is? It means people are willing to buy and hold the stock at a higher price. The market has established new demand for the stock. Conversely, if a market trades sideways in a box range, like what you can see here, for some period of time, it starts ranging for some period of time here, then breaks down to close below that support area. You can see it breaks down and close below this support area. It means that buyers were unwilling to step in. Buyers were unwilling to step in and hold the price at that level. It means buyers are not eager to buy this stock anymore. The bears are in control in this situation. I explained that bears means the sellers and bulls means the buyers. So bears are in control and that market may fall to lower price. As you can see, after ranging a little bit here, market drops to the lower prices. If a sessions candle broke price support, if a sessions candle, each candle, we call each candle a sessions candle. If a sessions candle broke price support, here was the price support, by dipping below it, but then closed inside the box range, imagine if it come back to the box range, that is not as bearish. This sort of sessions tells us that buyers step in before the close and demand was strong enough to push the price back into the prior box range by session's end. Now you understand how valuable candle formations are in the context of trend reversal, along with components inherent in those reversals, which are support and resistance. In the next episode, you will learn about powerful candle lines called spinning tops and doji and how potent they can be. We will also discuss additional in-depth market psychology as revealed by candles. Deciphering market psychology accurately is a vital part of your future success as a trader or investor. So stay with me and try to practice each episode, and see you in the next episode.